Okay, ladies and gentlemen, good afternoon and welcome to this Bright Blue and StepChange event here at Party Conference. We've been working with StepChange a number of years, so we're very grateful for their partnership. So hello to everyone in the room, but also hello to everybody on the live stream, wherever you may be. Thank you for watching. And you can also tweet about this event, so please do, if you want to do that, use the hashtags BrightBlue and CPC23, and our Twitter handles are @WeAreBrightBlue and there isn't one for StepChange. Yes, the title of the event is Spending, Saving, Surviving, a Conservative Plan to Support Under Pressure Households. And as all of us know, the cost of living situation has been very bad for over a year now, and people are struggling very much at the lower end of the income spectrum. So what we want to do in this debate is understand what the drivers of that are, whether the government support which has been put in place is working, what more can be done, both on the fiscal subsidy side but also on the regulatory side as well. And then thinking just beyond the state, also what the market does as well, and thinking about how we can improve access to affordable credit and whether the financial industry is doing enough to support and safeguard vulnerable consumers. So we've got a great panel joining us. Delighted to say John Glen, who is the Chief Secretary to the Treasury, is with us. Deven Ghelani, to my near right, who's the Director of Policy at Practice. There's so many Director of Policy positions, right, okay. So it's misled me there. Sacha Romanovitch, who is the CEO of Fair for All Finance. And Richard Lane, who will be joining us, is the Director of External Affairs at StepChange. So I will ask each speaker to do 5 minutes, and then we're going to open it up to questions and contributions from the floor. So John, may I ask you to go first?
Well, thank you, Ryan. Thank you for inviting me again. When I've come to these sorts of events previously, I was the Economic Secretary to the Treasury, and I spent half my time talking about banks and financial services and half my time with financial inclusion matters. Now, as Chief Secretary, I don't have to do the banks anymore, but I have to do a wider range, but this is something that's very close to my heart, which is and drives me as a politician, which is how can the state provide an effective safety net for the most vulnerable in society, and how can we build resilience across the most vulnerable in our community, which will always have to be, I think, an ongoing set of challenges and issues, and I think we made some progress. But I think there are some really important matters that we need to resolve in terms of how we can, on an enduring basis, coming out of this cost of living challenge, learn from it and get the market to provide, better access to affordable credit, better savings products, and better levels of inclusion for the most vulnerable in our mainstream provision of financial services. I suppose the immediate context in the light of what we've done from COVID and then the cost of living challenge consequential of what happened in Ukraine and the inflation and energy costs, has been very significant. We've tried to focus that on those who are means-tested benefits, and both last year and this year that has meant significant transfer payments. I won't rehearse them all, but obviously those that were on UC and pension credit, it was £650, then £900, and then obviously you'll be familiar with the additional payments to those with disability, those in band A to Ds, trying to find proxies for need, but they will never be completely efficient. But when you're designing a system at speed and you need to get that money out, that is one of the, I think, trade-offs that we have to make. I did a breakfast with the Conservative Christian Fellowship this morning, and with the Trussell Trust, and of course you'll have seen that food bank use has increased. I see that from the last survey, 3% of individuals living in households where food banks have been used, but the acute need amongst those 3% of households, is a real challenge for government. So I think what government have basically done is provide transfer payments and increase those and try and get those as targeted as possible. I think there is a role for regulators to help in terms of defining the appropriate access for social tariffs. Again, that is a delicate business because there is obviously a degree of cross-subsidy there, and getting that right balance of need and what are the parameters where that should kick in is really important. I think in terms of affordable credit, I'm trying to go through the questions you set us in a timely way, but in terms of affordable credit, I think technology and fintech and the opportunities to actually verify patterns of behaviour amongst all income levels, gives the opportunity to have a more honed profile of somebody's ability to repay debt, and I think that has been significant. Sacha will talk about what's going on in terms of fair for all and finance, and the evolution that's happened over the last few years. But the government have done things with credit unions to try and make them more accessible. I think we also have to recognise that we don't have a very high awareness of the value of a little bit of resilience. I mean, we have Help to Save, which is a much underused but very valuable mechanism whereby people can save up to £50 a month, which is obviously going to be an unrealistic amount for many people, but actually consistently saving a little bit will be matched by government at 2 points over 4 years, giving people a few £100s of resilience, which is really, really important. I mean, clearly the challenge we face is also about handling of debts, and for those of you involved in churches and faith communities, there's a lot of work going on to try and help people deal with debt, and dealing with debt is a really really important thing because it leads to more behaviours in terms of riskier sources of finance, and so we've got to find ways of improving handling of debts. And again, there's something about where the state seeks to recover debts, doing that in an equitable fashion to private sector. I think that the big point I would make is that the government is about actually trying to help people get back into work, and work is the best therapy for people who are in financial difficulty. But I think what I would say is that over the last 10 or 12 years, where we now have parity of esteem between physical and mental health, that the benefit system isn't optimally configured to help people who get into, have mental health episodes to get back into work. And I think we've got to do more to encourage people to get back into work, but also provide support, recognising that sometimes that's a difficult and intermittent journey back into independence and resilience in terms of being able to sustain a job. And that's difficult for the state to design a benefit system which is fair, but also has the right incentives in the right place. And that's why Mel Stride, my colleague, is doing so much to try and develop pilots with job centres up and down the country to make that work. I also think we haven't fully resolved the issues around financial education. We have an imperative around financial education, but I don't think it's universally rolled out in a way that we can rely on to actually give people the baseline levels of understanding. I used to say that if you could explain to school children before they leave school the value of compound interest, both for savings and for debt, it would be a very, very positive thing. But I think we're some way from that, and that's because our school system, we have a national curriculum that actually adding that onto it with all the other good things that people suggest, we've focused on actually raising the basic standards. So I suppose what I see at the moment is people in challenging circumstances being helped and will be helped through this winter as we deal with the costs of energy. I see progress in terms of market solutions to provide more access to more affordable credit, but there's more that can and should be done. But I think the real challenge is how to develop a benefit system that recognises the uncertain journey that many people start on when they get into the benefit system, stopping people getting onto a path where they're inevitably going to be reliant on benefits, and how we can maintain flexibility and compassion whilst also being very clear about what the state's role is, which is to provide temporary relief as a stopgap to a pathway to independent work, which is going to be more satisfying and healthy for that individual and society as a whole.
Great, thank you, John. Just to say, if you're at the back, there are some seats available at the front, so if you dare come down the aisle,
we won't bite, I promise.
And just to say, on Twitter, the Twitter handle for StepChange is @StepChange, so if you want to use that as well as We Are Bright Blue, please feel free to do that. John, a question for me is, one of kind of Bright Blue's core areas has been around work and welfare, and we did a report earlier in the year looking at the social security system and looking at both subjective and objective measures of financial well-being for people who are dependent on working age benefits. Of course, nearly half of people on working age benefits are one household member is in work now. And what we found is during the pandemic, the £20 uplift was actually quite useful in improving those subjective and objective measures. And it's interesting what you say around the kind of short-term relief, because what we did find was that the replacement rate in the UK, that is the amount that you get when you rely on benefits when you come out of the job that you were previously in, is lower in the short term in the UK than it is in other countries. But in the long term, it's actually higher in the UK, the replacement rate. So, but that seems to sort of go against slightly the sort of idea of going for this sort of short-term support, which might be more kind of generous to begin with to help you on that path, but then becomes less generous over time, like some continental countries do, like Denmark, for example, which is always sort of flagged as a good example of that. I wonder what your reflections are on that.
Well, my reflections are, being in the Treasury at a time of COVID when it happened, is that we had to develop a number of interventions very quickly, and perhaps we don't always have in the the core of a crisis like it was, where the Prime Minister, when then Chancellor, was saying, well, how do we get the furlough scheme working quickly? What do we do to protect charities? What do we do to protect businesses? Bounce back loans had to be developed literally overnight when it was clear that the regime we'd set up post-crisis wasn't going to allow banking loans to happen. And I guess the same was true with some of the emergency interventions we made across the benefit system. And, then you get into a situation very quickly when you've taken on all that debt of affordability in terms of, if you're spending 276, I said 46 this morning, 276 billion pounds, and you've got, a breach to the notional cap that exists, how are you going to manage that? What are the changes that you can... So I suppose what I say is, I'm not going to comment on the specifics around, that process, but it's always infused by what's the projections of making enduring changes in terms of the aggregate amount of money we've got in a strained situation. And I wouldn't want to be in this. And when we won the last election, I didn't expect we'd be in a situation where we shut down the economy 3 months later and we've incurred hundreds of billions of debt. Nor would that debt be the interest payment on that debt would make it the second biggest line item after the NHS and social care. So I suppose what I say is, as ever, Ryan, policy has to be developed in the reality of the full context of the situation we're in. And of course, when that £20 uplift was going to be changed, there were many who said, well, this was something that needed to change, but of course we couldn't afford it in normal times previously. And I knew that would happen when you make exceptional changes, that everyone wants things to last forever. And of course, we can't afford all that we would have. And we've got to therefore find a whole range of interventions to help people get through. That doesn't mean to say there isn't scope to develop new policy, but I think, obviously now we're facing a challenge in terms of the legislative window that exists in a fourth session Parliament and what compromises and changes you make elsewhere in the budget to accommodate that.
Great. Thank you, John. So when Bright Blue did this report, we looked not only at the adequacy of the social security system, but the accessibility of it as well. And obviously universal credit is a centralised benefit, but there are a whole host of localised benefits that people can get as well, like Healthy Start vouchers, council tax reduction. And what we did find was actually there was a sort of decline in take-up over the past 10 years. And I know, Deven, you're very focused in the work that you do on making sure that people who are eligible for the support that they get actually get it and receive it. So very interested in your reflections.
Yeah, no, absolutely. So yeah, thank you. Brief introduction to policy and practice. So and myself. So my background is social security. I got fired from a startup when I was 27. Claimed benefits, saw how the system worked, broadly saw that it didn't, and I've been pulling at that thread for the last 16 years, and this is where I've ended up. But Policy and Practice runs one of the benefit calculators on gov.uk. We wrote a report earlier this year on the £19 billion of benefits and other support that goes unclaimed each year, which can make a big difference in stabilising people's finances. And I guess the couple of directions we're going in, one is to make that less reactive, so if people know about it, they'll go to a benefit calculator and use it. But actually now we're working to use data to fundamentally proactively identify people who are missing out and letting them know. We ran a campaign across London. Over 10,000 pensioners got letters saying that they are definitely eligible for pension credit, just apply, and 26% of those went on to take it up. Now the net impact of that to those Londoners is over £100 million because they get it each year for the rest of their life. That's running a single campaign. So this can make a huge difference if people can and are able to access the support. The question I got asked when we spoke about it on Moneybox was, what about the 3/4 that didn't take it up? So there's still plenty more work to do here. Just to, I guess, respond in the broader sense to some of the provocations that I think you Bright Blue put to us. I guess I'll talk a bit about the good, the bad, and the ugly of the last few years. So I think there's been lots of really good stuff the government has done. The responsiveness to some incredibly challenging circumstances. You've spoken about it already, John, but I think it's worthwhile listing. Discretionary housing payments exist for people who can't meet their housing costs. You've got the Holiday Activities Fund, which local authorities help to get out to people. You've got the Household Support Fund, which is £1 billion a year worth of support that goes to people. You had multiple tranches of energy support. The amount of support that we all got, a certain amount that people only on means-tested benefits got, because they obviously need more support, and things like energy efficiency measures that are accessible, and some of those I can see more funding going into that. So you have this whole range of being responsive and reactive to needs as they arise. So that's, I think, a very positive thing. I think the bad is almost a mirror image of that, is that we're having to be responsive and reactive to situations that in some cases are externally created, like a pandemic, a global pandemic, cost of living crisis, which in some respects has been externally driven by energy costs. But actually some of it hasn't been, right? So we've got housing costs going through the roof. We've got a rental market that's incredibly difficult to stay on top of. I employ a lot of people in London who themselves are pretty well paid, I'd say. I mean, arguably I would say that. But
not what they tell me.
Yeah. But actually, struggle with rents and are facing some pretty significant rent rises, and that puts pressure on me as an employer, actually, and affects kind of how we grow. I've written something else here. Some of it's also social security, right? So you've got self-inflicted changes to the social security system. I worked and helped develop universal credit, but actually I didn't do it in the context of a lot of austerity-driven measures to take money out of the social security system. So you've got things like the local housing allowance freeze, which means if you're on a low income, you have to top up your rents with other money. In the context of energy bills, you need to pay your energy bills with that, which means there's more dependence on regulated sectors, water energy companies, to bridge that gap, which again, they do their best, but actually they're also quite narrowly focused on their energy bills, their water bills, which isn't really financial resilience in the broadest sense. So that's some of the bad. The ugly/beautiful, depending on kind of how you like the spin you want to put on it. I mean, I talked a bit about the £19 billion of support that goes unclaimed each year. I think it's bad that happens, but actually I think the measures going into, and Sacha can say a bit more about that, to helping people claim that. I've spoken a bit about some of the work Policy and Practice does, but I think you guys take a much broader view in enabling that. The potential for technology data to be used and shared. The work we do with the local authorities is genuinely transformational. I talked about the pension credit campaign. It really ought to be done at a broader scale with more ambition. to my mind. And I think what's stopping that is more will than ability. And I think, what you leave behind, so you now have organizations in regulated sectors who are taking much more of an interest. I've been knocking on that door for, a decade or so, but actually in the last 5 years, partly because of cost of living crisis and other things, they are much more responsive to not just helping people with their water bills. We're doing a piece with Anglian Water, for example, where if you go on gov.uk, use our benefit calculator, we identify you're eligible, you click a button, and all of that information is passed, you give consent, all of that information is passed into Anglian's billing system and you get the social tariff. So these are like innovations that I think are now starting to happen. Probably a bit too optimistic a spin. The practice can only make up for the policy so much. But, we work across both of those areas, and hopefully that provokes some useful conversation and discussion, and perhaps a little bit of optimism in the direction we could go.
Great, thank you, Deven. So I saw some analysis that Policy and Practice did earlier in the year, just how far up the income spectrum people claiming universal credit is, often because of the costs of childcare or the costs of
renting.
Housing, which struck me because it's interesting just in terms of what helps people who are the most vulnerable. Is it targeted support or universalist support? And a lot of schemes like the energy price cap, the energy price guarantee, the furlough scheme is very universalist in its approach, and obviously UC is not yet universalist, but it is creeping up in terms of the income spectrum. And I'm just, is that worrying that it's sort of creeping up so high, going towards a universalist thing? Does that take away from vulnerable households, or is it the case that kind of more universal support actually improves take up amongst more vulnerable households?
So I think you need to look at the symptom. I think you're talking about the symptom, and actually we need to talk a bit more about the cause. So the symptom is universal credit is going higher up the income scale because rents are supported, and the way universal credit is tapered, 50% in the pound, is if you get £2,000 a month in rent, which you can do in parts of central London, probably more like 1,000. That's removed at 50 pence in the pound, so you can earn £2,000 a month, and you're still before your housing support even gets fully eroded. Very crude numbers, right? I can be more pedantic about it, but it's probably not helpful here. So it's going up the income scale because of the cost of living, because the cost of living is rising. So it's kind of normal for it to do that, and I think it's actually quite hard to convey that in a setting to people who perhaps aren't as familiar with the social security system. I actually don't think more universalism is a bad thing. We wrote a report. In that report, one of the things we concluded is ending the savings limit. So if you have £16,001 in savings, you don't get universal credit. If you have £15,998, you have a tiny bit of UC taken off, but you still get this extra support. And my colleague who's writing the report is renting in London with a wife and child, and he figured out he had savings, but if he hadn't had savings, he'd be getting an extra £700 a month. And actually, you do create these, and I've given this evidence to the Treasury Select Committee, and I've spoken about it at other events here today. You do create these cliff edges. And that's kind of unnecessary. So that £16,000 limit has been in place since 1990. So it's kind of the effect of not really looking at these things moving on. Now, sadly, all of these things cost money, as John would probably wishes he had some. But so some of these things do cost money. But then there's a fairness and justice argument here, which is kind of the position that I think we also find ourselves in. I'll leave it for the discussion, I think.
Great. So, Sacha, I'm going to come to you. John said, there's obviously a limit to what the state can do. So, we have to look sometimes beyond the state. So, interested in your reflections.
Perfect lead in, thank you, and thanks everybody for joining the session. So just by way of introduction, Fair for All Finance, we were established, we're actually funded by dormant assets, so money that people forgot about goes to people for whom every pound counts, and really with a focus on saying, actually, are there things that could actually be adjusted in terms of how the market, and particularly the financial services market, provides services for people in financially vulnerable circumstances so that they can have those vital stepping stones, so they can actually build their own safety net so that when life's inevitable ups and downs comes, they can be resilient to them. I thought just in terms of framing, it was probably worthwhile just doing saying two things. One is, when we talk about people in financially vulnerable circumstances, our research is there are about 17.5 million people who in different ways are in financially vulnerable circumstances in the UK. And 3.9 million of them are what we call the squeezed and sliding. So people who actually, 50% of whom have mortgages, who might have actually been in a situation where they've taken on amount of household debt, who are in situations where actually it was fine, but the balance is tipping. So you have got this, when you talk about under pressure households, it's worthwhile sort of saying that actually there's a really broad spread of people we're talking about, to people for whom there has always been a cost of living crisis, to people for whom it is very new. And I think the other thing that's worth bearing in mind is, and I think it came home to all of us through the pandemic, didn't it? That actually, a life event, a job loss, a bereavement, a relationship breakdown, a health event, be it physical or mental health, those are things that can actually tip people from being just fine to actually life is very challenging. And, I think it's always interesting for all of us to think how many of those are each of us away from actually that really difficult situation. As John rightly said, you've also got the sort of situation in terms of people's financial safety nets they have. 14 million people in the country have less than £100 in savings. Your washing machine breaks down, it's a crisis instead of actually something that, that's a bit of a nuisance. And also low financial capability. Just out of interest, in terms of where people learnt how to sort of take care of your money, how many of you learnt it from your parents? Okay, so I think this is a really interesting thing, because when you look at people in financially vulnerable circumstances, the vast majority of them have children. And so I think there is a really interesting thing for us in terms of how do we equip children to learn great habits. Actually, if we can intervene and support parents at the time they're making decisions, because that's what the evidence shows, right? At the time people are making decisions is the best possible time to actually provide them with the information to make better decisions. If we can intervene that with parents, they will inculcate those very skills with their children. And I think that's a really great opportunity for us to think about as to how we're designing financial services and financial journeys. Just sort of going on to the more specifics into the question. It's always good sitting two down from the panellists because you can't actually kick me. Cunning plan, recommend it to everybody. But, when we're actually looking at, how do we support people to build resilience? We know that actually, if you've got unpredictable incomes and lumpy expenditure, that actually, the financial system isn't always designed for you. So you often pay more in terms of your financial services, be that everything from motor insurance, which is a compulsory insurance, which you have to have if you've got to have a car and you want to have a car to get to work. It's not an option. Well, some people might think it's an option, but it's really not a good plan to take that option. Right through to affordability of things. Even if you think about it, your shopping, how much do you have to have in your basket to qualify for free delivery? Anybody know? It's over £50, right? And so, for people for whom they've maybe got sort of £10 and they're doing it like that, they're sort of priced out of an awful lot of these things. So I think thinking about customer service design from how do we make sure that we don't have the poorest paying more is really important for us. But then it goes into, well, how do we provide these stepping stones to providing people the opportunity, if you've only got £100 in savings, if you're paying more for everything as you go, and £10 is a lot of money to you, then what are the levers that we can use that can actually really make a difference? So I see Robert Kelly from ABCOL, who represents, I think, an awful lot of credit unions in the UK. There's some great work that credit unions have been doing with people. As you may or may not be aware, with a credit union, you save with them and you can also borrow. They've been doing some great stuff, actually save as you borrow. A really simple thing. You might get a loan for that washing machine that's broken down or that car that you need to repair. But at the same time, you overpay that loan slightly each time. And so by the end, you've got a car that works and you've built up a savings pot and a savings habit that can be really powerful, because I think, John, we were together in South Manchester with that lady who had taken a no interest loan, and she was like, someone trusted me. She was able to actually pay for her brother's funeral, who was otherwise going to have a pauper's funeral. She was then able to, start to actually get into work, to start to save. And she changed her belief in herself as a consequence of those stepping stones put in place. So looking at how do we make sure products are more affordable? How do we make sure people have got access to products that actually help them to actually make better decisions? And then what are things we can do to make sure that we've got those available at the scale needed? And that's the particular area that we're really focused on now. So we've got a pilot going on a no interest loan scheme, which has been very dear, I know, to John's heart. And we're taking it steady, because it would be really easy to go quick with something and find that fraudsters and all sorts had taken advantage of it. You want to prove the evidence of what works, right? But what we
fight hard to keep it going.
I know, and it was very much appreciated. But it was really interesting. It's early days, but of the people applying for the no interest loans, we've now got 85% of people who've applied for one of those has a poor or very poor credit rating. So you'd think that the arrears rate on that was going to be pretty horrendous, wouldn't you? It's running at 3%.
Brilliant.
So, people actually, and this is small amounts of money, it's up to £1,000 repaying back over a year. They're using those loans to get nursery places, to actually replace household appliances, to repair cars, and we're getting a track record of people getting into work. So, it's just an example where actually by thoughtful design based about understanding real people and real people's lives, you can actually start to design products that really make a difference. And so I think I'll stop there, because I know you're giving me that look. But
that's just my resting face.
It's a really good resting face. But I think the message here is that I think there is a massive opportunity. Financial services, serving people with unpredictable lives and unpredictable incomes, these can be customers for life if you give them the right products, the right services, the right stepping stones at the right point in time. The difference it can make is enormous, and I think that's a really exciting opportunity to grasp.
Great, thank you. So thinking about vulnerable consumers, a lot of their access to credit, the assessment is backward looking based on their sort of financial history and their credit score. And I'm just wondering, is the kind of lack of support that they are getting and the choice that they're getting a result of very restrictive terms for their access? Or to what extent does debt aversion play a role as well? To what extent are people just not going to kind of the support that's available because they're just frightened of taking out a loan and not being able to afford repayments? I presume it's a mix of these things, but what's the sort of broad composition?
Well, it's an interesting thing. Are people not borrowing because they're worried about taking on debt? I think the evidence is broadly no. I mean, interestingly, what actually is often happening is people are turned down from debt, or even the products aren't available. Like, you may or may not be aware, but if you go to a mainstream bank and you want to borrow £300 unsecured loan, for an awful lot of people, that product is not available to them. So it's not that they're applying and they're getting turned down. It's just not available, full stop. So then they might go to another provider where actually the credit risk is seen as too high for that provider to take on that person. So what do they do then? Well, actually, we're doing some more research, but we're sort of building on it. But the research we did earlier in the year on illegal money lending is in the UK, 3 million people over the last 3 years have gone to an illegal money lender to borrow the money, because the need hasn't gone away. Right, the need has not gotten away, and so and I think that's something that we really need to pay attention to. So, and I think that thing around people being judged on their state rather than their trait is a really interesting one, because there are an awful lot of people who are credit invisible. When you look at people at the sort of more struggling end of the spectrum, they're not even leaving a digital footprint. You know, there is still an awful lot of people, and I know the guys from StepChange, Rich will bear this out, you know, people who, they may have a bank account, but actually how they budget is they draw their cash, they keep it in the traditional jam jars, and they spend like that. So there isn't the digital footprint to be able to look at things. What that means in practical terms is often to make that credit risk assessment, you've actually got to have just a more labour-intensive process. I mean, Robert will speak to this in terms of his members. They bring an enormous amount of care to sit down with someone and say, right, show me your statements. Let me talk you through. Let's understand what you're doing. Because they invest that time, they can then make that decision to back somebody. That's really hard to automate for an awful lot of people. And that, so you find that, you know, a lot of businesses don't go into it because it's just more expensive to serve that customer group. And that's why we need to sort of look at how we build all of that side of stuff as well.
Great. So lack of access is definitely predominantly
Yes.
the main reason rather than debt version. Thank you. So Richard, finally from you.
Yeah, thank you very much. So I'll start with two apologies. Apologies for being a few minutes late. Even more unforgivable to be more late than a cabinet minister with how crazy your diary will be this week. Also apologies, despite what my little place card down here says, I am not Peter Tutter, now Head of Policy. My name is Richard Lane. I'm the Director of External Affairs. Unfortunately, let's just say Peter had a team day last week that turned into a bit of a super spreader event, so unfortunately is not with us. Just to reassure the rest of the panel, I was not at that event, so I think we're okay. Delighted to be partnering with Bright Blue again. It's always really important for us to have these conversations, so thank you to them for all of their hard work to pull this event together. Thank you in particular to the panel, and thank you especially to John. I mean, I very rarely go anywhere without someone speaking glowingly about the work that John does, and I think everyone in the sector would say that we are absolutely safe in the knowledge that we have an absolute advocate and ally at the heart of the Treasury, which means a huge amount to us as a sector, but also to people who are struggling in problem debt. And I mean, there is a very positive story to tell for some of the interventions that the Treasury has put in place over the last few years. For those who don't know, StepChange is the largest debt advice provider in the United Kingdom. It is our 30th birthday this year. We've been celebrating our 30th birthday. Over that time, we've helped about 7 million people with their financial problems get back on their feet. On an annual basis at the moment, we're helping about 500,000 people and taking about 180,000 of those through full FCA-regulated debt advice. I would say what we're hearing from our incredible frontline advisors is that things are tough. It is getting harder to help people. We've been doing this for 30 years, and I think over the last, say, 5 years or so, we've probably seen the most drastic change in the makeup of our client base that we have seen. We've seen incredible rises in the amount of energy arrears that our clients are coming with. That hit an all-time record last month. That is obviously particularly worrying because that has gone up considerably over the summer months. We've seen a change in terms of the organisations who are referring their clients to us. Last year, for the first time, the top 3 organisations who refer their clients to us for help are now utility companies. That has always historically been consumer credit card companies, all of the big ones that we would work with. So there's been a real change, and that is, of course, being shown in our data as well as what our frontline advisors are telling us. We now know that 36% of all of our clients, so more than a third of all of our clients, are what we call deficit budget clients. So that is after we have taken them through full debt advice, we have put them on the most stringent budget we possibly can. We've signposted them to income maximisation, benefit advice and guidance. They still have got more going out than they have got coming in. 56% of all of our clients are now disclosing what we would call an additional vulnerability. We determine that all of our clients who come to us are vulnerable because they are financially vulnerable, but 56% of them are now telling us they have some other sort of additional vulnerability, whether that's mental health, disability, addiction, gambling addiction, alcohol or drugs. So that has seen a real increase. That's partly because we've just got better at identifying it, but I think it is also reflecting a change in circumstances. It is just getting harder to get people to the end of debt advice. It is harder to find them a solution. And I think what we would say, and others in the sector would say, is we are really pushing the limits of the tools that debt advice has got in its toolbox. We are not a magic wand. We can't solve people's circumstances if they fundamentally have got more going out than they've got coming in. There are some particular areas, I think, as an organisation we're looking at, and I think some areas where we would say to the government where we could possibly see some action. Firstly, not necessarily just for the government, but debt advice is certainly heading towards the capacity of how many people it can help. We are certainly capacity constrained. And just to be clear, I don't sit here thinking that the answer to that is John cutting a blank cheque for the sector. I certainly don't think that's right. I think the sector does need to become more efficient. The sector needs to become more effective in how it helps people. It needs to embrace modern technology in terms of how it helps people. The idea that we can offer face-to-face advice for everyone who might need debt advice is just not going to happen. We have gone through a massive technological transformation over the last few years, meaning that all of our clients can now 24/7 go through digital debt advice. They can, of course, have human intervention when they need it as part of that journey. But I think we need to see a long-term sustainable funding model for the sector. And I think in particular, that's going to involve binding in some of those people who are not currently contributing to funding debt advice. Of course, I'm not going to sit here and name names, but we would certainly look towards the utility sector as a sector that historically has not contributed in the same way that the big sort of consumer credit organisations would do. We're also worried about our clients who are in receipt of universal credit. Our clients in receipt of universal credit are considerably more likely to meet the definition of destitution than our clients of any other circumstance, including those on legacy benefits. And that is particularly true for clients who are facing some level of deduction from their universal credit. I know that's something that we in the sector have made the case for over a number of years. There has been some positive progress there. But for me, that is broadly about the public sector starting to embed some of the very best practice we see across the private sector in terms of how we treat people in financial difficulties. We're also seeing real distress amongst our clients who are in the private rental sector at the moment. It is by far the most common type of housing tenure that we see amongst our client base, and we're finding that their outcomes, their financial outcomes, even their health outcomes are worse than any other client tenure that we have amongst our client base. For example, they're far more likely to be reporting poor health outcomes because they're saying they're not speaking to their landlord if they're living with mould or other conditions in a house because they're so terrified about eviction, because they know that they would be homeless because they certainly don't have money for deposits. They wouldn't pass credit checks to be able to find somewhere else to live. Amongst our client base as well, we continue to see a disproportionate particular groups coming to us. So our clients are overwhelmingly women, so more than 60% of our clients are women. That is overwhelmingly driven by the fact that nearly a quarter of all of our clients are single parents, and 90% of those clients who are single parents are women. Our clients are typically younger, so overwhelmingly they're under the age of 40, and as I said, in the private rental sector as well. I'm going to wrap it up because I'm keen to get to questions, but I would say that as I said at the start, there is some real positive work being done, and I would echo what Sacha said. We are evangelically supported about a sort of no interest loan scheme. Obviously we need to kind of test that and base that on evidence, and that is enormously important, and it's great that John has been a real champion of that. In whatever mechanism it is, I think unlocking ways that people can access affordable credit in the market is enormously important. I would also say, because I know John's passionate about it as well, we are also evangelically supportive of the Help to Save scheme, which I think has been really, really important, and we would like to see potential more awareness of that and an expansion of that scheme as much as possible. So I think I'm probably getting Ryan's look now that Sacha's had, so we'll wrap it up there.
Great, thank you. Okay, I'm very keen for questions and contributions, so a microphone is going to come round. Please wait for that because we want to make sure that people on the live stream can hear you. And if you could say who you are and where you're from, that would be great. So we'll start with this lady here on my right.
Thank you very much. My name is Anita Heapy and I'm from North Somerset. I'm on the coalface. I used to be called a mortgage arrears counsellor, and I'm now more likely called a field agent. I'm sent in by the mortgage companies to try and sort out people's debts. My workload has trebled in the last few months. I shouldn't be here today. I should be working, and I'm covering from Gloucester down to Cornwall. Now, the points I'd like to make from what you've all said, because sometimes I don't think people actually understand. Mortgage interest relief, or the loan that they now have. Does anybody understand how long it takes to get that? The mortgage companies lose the M12 form. I have to tell people to send it recorded delivery. So you have months before they get that intervention, and pre-action protocol for recovery of repossessions could have kicked in by then. We need to do something about that. Next thing is StepChange. Yes, you do a brilliant job, but I would say 90% of the people I see don't engage with anybody till I stand on their doorstep, and I'm presented with carrier bags of envelopes. The only people I can get out to deal with the people I see is Christians Against Poverty, because they will come in after my one-off visit where I've gone through what's happening, an income and expenditure, and if there's a CAP representative in the area, they will come out to them. Otherwise, those people will not work online. They're not the younger cohorts you're talking about. And they can't sit there, or they won't go and sit because of the embarrassment at the CAB local office. And finally, sorry, just one thing. Yes, absolutely agree with you, C. It's changing people down and further into debt. But if you want to speak to me any more about what it's like, come out with me for a day, because it's hell out there now.
Great, thank you, Anita. This lady behind, and if we could keep contributions quite pithy, that would be great, so other people have a chance.
I'll stand up because I think I'm sort of hiding behind there. Katie Watts from Money Saving Expert. Obviously, we're in quite a broken energy market, and John, you spoke of sort of government's role being to make sure that the most vulnerable are captured and have a safety net. And drawing those lines is quite difficult. Last year, the Treasury promised a consultation to look at options for the future of energy support, including a social tariff, and that seems to have dropped off the radar. So my question is that policy gone? We're here to talk about policy after all, or will you do it? And to the panel, do you have a policy on what kind of energy support would best help your clients and your areas of research?
Great, thank you for that question. And then let's go to this gentleman here.
Good afternoon, thanks very much. Just as a matter of disclosure, I'm Phil Andrew, I'm Chief Exec of Orbit Housing, but I was Chief Exec of StepChange Debt Charity. Now I can objectively see that StepChange is an extraordinary charity, so congratulations, absolutely marvellous, absolutely marvellous. And one thing I would say, just maybe to correct you there, Richard, even though you don't work for me anymore, if you felt the need, John, to write a large cheque, I think £25 million a year extra would do a lot of good. So just a very quick one. In my position as Chief Exec of Orbit Housing, we've got about 100,000 residents who are really struggling at the moment. When the month is halfway through, they have nothing left, and something like the no interest loan scheme would be unbelievably helpful. So I guess my very simple question is, how quickly can it be nationalised? And sorry, I'll rephrase that. How quickly can it be rolled out nationally and at real scale? Thank you.
Great. And then finally, just this gentleman here.
Hi, Tim Patmore, Conservative Tenants and Landlords Forum. I've got really 2 points. One is one that the Spectator seems to make over and over and over again, that there's 5.4 million people on working age benefits. And I swear I know at least 3 people who it's like lockdown never ended. They just still sit at home, claim benefits and so on. I was wondering what could be done to address that. And the second point I'd like to make, I brought my rental contract along to conference because there's something I've seen in this rental contract and ones I've got from other agencies. It says, private residential use only, the tenant will not carry out any profession, trade or business whatsoever on the property. And given that private renters are 1 in 5 people, that would mean, given you're a panel of 5, 1 of you will be banned from starting a business. How do we address that second point? Thank you.
Great, very good question. Thank you. John, any reflections?
Yes, so let me see what I can do with that. Look, on your point, Tim, about the number of people on working age benefits, it's a very difficult matter for us as a party because, typically there are a lot of people out there who want to vilify us as uncaring, unkind and so on. But I do feel we've seen massive shifts in the labour market since COVID. And we have got to come to terms with that. And the interventions that we made in budgets around childcare, around work capability assessment, trying to get people back into work to arrest this situation where vast numbers, disproportionate numbers in this country compared to other countries have withdrawn from the workforce is something that we are engaged in. We're trying to do it in a sensible fashion, but it will mean some tough decisions as we move into the autumn statement, because it's not in their interest, not in the interest of the economy, nor the taxpayer. With respect to your point about the contracts, I don't know, I mean, I think that is very irregular and needs coming to terms with, because of course so many people can legitimately and productively work from home, doing things in front of a screen that are economically significant, and we need to look at that. To Katie's point, I can't give you a readout on the social tariff. I think we've got a new Secretary of State who will be looking at those matters, and I just can't tell you exactly where that is, and I don't know for certain, so I'm sorry, but that's the straight answer there. Phil, I can't provide that check, but I do think several points that you made, and I think Councillor Heapy made as well, around the whole sort of issue of people are distressed, different groups are in distress, and obviously the familiarity we've had over the last 15 years with very low interest rates, it's been a real shock to come to terms with that and the distress that people feel. But I think the point you were making was about the efficiency of the access to some of the ameliorations that exist out there, and I think that that I'm very happy to engage with you on what actually happens and what we can do as a government to make that better. I mean, obviously, we intervened with the mortgage charter to try and normalise over 90-odd% of mortgage lenders what interventions can we formally give people as an option. But the best thing we can do is get rid of inflation, see interest rates stabilise and then come down, and actually get into a better place. I can't. What other points? The nationalisation of no interest loans, so to speak. I mean, I think Sacha's right. It needs to be validated. We need to show what are the criteria. This was transported from what was doing very well in Australia, and we've got to get it working in this context. But the Sacha helpfully set out the rather unexpected consequences of a high profile of risk of people actually being able to deliver the repayments, because you're taking away that 100% interest, which obviously was capped in 2018 by the FCA. We do need to look at that as something that we can expand, and I also think there's opportunities for banks and financial institutions to match that pool of investment, because that was always the intention. Yeah. This is where the responsible citizens need to step up to the mark to deliver something for those who for lifestyle, historically reasons and difficulties in their lives have been unable to access the products that many of us in this room could access. I don't think I've covered everything.
Well, there was a question from Money Saving Expert.
Sorry.
Social tariff.
Yeah, I did. I answered that.
I said I
didn't know the answer. If you want me to read it, I've said it again. I'm sorry.
Okay, no worries. Sacha, did you want to come back on perhaps one of the questions? Yeah, and if we John has to leave, so if we could give a round of applause to John. Thank you very much.
I'm gonna roll two into one, because I think it's maybe a sensible way to do it, because I think this thing around people needing support but actually being ashamed, worried, not able to access support is a massive issue. I do think, particularly for people who've got mortgages, they do have a digital footprint, and it's one of the things that I'm talking to the banks a lot is actually, I don't know about you, but my bank is really good at giving me nice nudges on, oh, you should try and empty this savings account. And actually, there is a massive amount of data that banks hold, which could actually mean that they can do early interventions to actually speak to people and say, look, we're seeing changes in your habits here. Do you need some help? Yeah. Well, I think this is one of the things that we need to make. We need to really think about is that, how can you intervene? How can you use data to actually get support to people before they get into a really challenged situation? And I do think we need to look at that in terms of customer journeys. And it's one of the reasons. And this leads into the second question, Ryan. So in terms of how can we roll out new products and services quickly, it's really important, particularly when you're working with debt, that you're not just chucking debt at people and end up finding that people are over indebted, but just in a different way. That's not a good situation. But actually being able to really test and validate, right, what needs to happen in the customer journey so that if I am giving a no interest loan to somebody, that's actually proving to be a stepping stone rather than another millstone is really important. We're just at the stage now where we're out for providers to actually work with us on scale up of nils based on what we've done already. I can see the guys from Zilch sitting in the front now. I know that you've got paperwork with you. I know you've got paperwork with you where you're reviewing, so fingers crossed. We shall have some bids, coming in from commercial providers so that we can now test how the digital journey works as well as the face-to-face. And we've also got looking at a consolidation loan product, which is very much focused at the squeezed and sliding, 50% of people with mortgages who maybe have accrued 5 or so debts and are now at a situation where that's become unaffordable. What if you could intervene early, help them to reschedule that and reset? And, an example that we've had is a nurse who'd accrued £9,000 worth of debt. By being able to reschedule, as it happens with a credit union, they were able to save £300 a month. £300 a month can actually really make a difference, I'm sure you'll know, in terms of people's lives. So hopefully showing that the right product at the right time and with evidence to show how it scales so it really is a stepping stone, not a millstone, is absolutely, I think, the way to go.
Brilliant. Thank you, Sacha. Deven.
Well, just a quick point. I started policy and practice from my rented flat and flipped the kitchen table over when it was time to work and folded it back when the family came home. So I absolutely think you should be able to do that, right? It holds people back and depends how practical a barrier it really is. But I actually wanted to challenge a couple of points from both around the social tariff and around the no interest loans thing, partly so you guys can set me straight. I'm going to frame it much more as questions, I think, rather than sort of statements. But I think, so the first point on a social tariff, I'm a little bit concerned, right? As I said in the intro, I think people are getting into energy debt because they're not getting enough support in the first place, arguably. And I think understandably, energy companies and water companies and whoever else isn't getting their bills paid on time can be a little bit blinkered. They want to get their bills paid. And actually it takes someone like John or someone like Mel Stride to take a broader perspective on people's overall financial resilience. I worry a little bit about, this £19 billion is bigger than it used to be, partly because you've got these regulated industries now responsible for allocating that kind of support. So I think, frame it more as a question. I'd love to hear and engage with you a bit more afterwards, Katie, around that versus just calling for more support to those that need it the most. And then rolling that into the no interest loan. I mean, the level of no interest loans or low cost loans that are available compared to when I started working in the sector 12, 13 years ago is so much greater. I mean, I think that's credit to the sector. I don't think it's made as much of a difference as we would have hoped, is my potential challenge, right? So you can access, through universal credit, you can access the advance, but also once you've paid that off, you can access a budgeting loan, which is effectively a no interest product of a month's worth of UC, which can be worth £1,000 plus. You've got things like the buy now pay later schemes, which actually sound okay, but actually can create challenges too. If you talk to the advice sector, again, is it a millstone? Is it I would use those products incredibly well. A lot of people don't. I think is the other, and then the other one is the salary advance scheme, which is again used well, brilliant. I need an extra £200 to sort out my car that's broken down, essential. Versus it becoming something that I just use to get by month to month. It's drawing that distinction, and actually I think we might be again slightly at risk of treating the symptom rather than the cause. I'd love to engage more with those in the room about it.
Great, thank you, Deven. Richard, final thoughts to you.
Yeah, just really quickly. So on the mortgage point, we're seeing a small increase in mortgage holders coming to us. It's not kind of a tsunami yet. I mean, what's interesting in that is we know two things. One, of the clients who've got mortgages who are coming to us, they're the most likely now to be negative deficit budget clients, which just shows how drastically their expenditure has gone up. We know also broadly amongst our clients that they do wait between 12 and 18 months from the point they know they're in crisis to getting help. You mentioned obviously CAP. CAP is a fantastic organisation. Gareth is at the back there. We work very closely with them. I mean, there is something generally, this is maybe a slightly niche point around the sector, in that funding mechanisms have put in place a level of competition in the sector.
I don't shy away from competition, but that competition should be about improving client outcomes and getting the best outcomes for clients, rather than competing about how many clients we can kind of all get. And I think we probably need a bit of a grown-up conversation about what's each other's corner in the sector. So CAP is fantastic at doing face-to-face for particularly destitute. We're a mass telephony national provider, and we should be very clear about what each of us in the sector is doing, rather than trying to compete over the same funding pots. We should be clear about whose each role is. The two other bits, agree, Katie, as you know, because we were in a meeting last week, agree with you on social tariffs. I think that's absolutely right. And there was a slightly tangential point on landlords, which obviously we've been talking a lot about in the private rental sector. You know, we don't obviously subscribe to some of the stereotypes that these are big faceless landlords. Obviously, lots of people are small landlords who need support to be able to put in place additional guidance, additional signposting for their tenants. And actually, if there was some probably small level of support put in place to say to landlords, okay, if your tenants are struggling here, this is how the pots of money you can signpost them, these are the hardship funds you can signpost them to, I think would be a very simple way that we could put in place a bit more fairness in that market.
On that, have you spoken to the National Residential Landlords Association? If not, I can put you in touch with them, because they did another fringe event with us. But yeah,
Great.
Just thinking of the connections there. Great. Okay, thank you everyone for joining us. It was a really, really interesting, detailed discussion. Learned a lot. Just to say that we've innovated in the way that we do fringe events. So you can stay around for the next 15, 20 minutes and network with people, both the speakers and other guests, to carry on the conversation and enjoy the food at the back. We can't have food waste, so please take as much food as possible. The other thing I should mention is, if you're interested in Bright Blue and supporting our work and being involved in our work, please do speak to any of our team members and come to future events, become a member, those sorts of things. And you'll see on the chairs you've got a Bright Blue goodie bag, so plenty of reading in there. In fact, our latest magazine, which we released this autumn, has got an interview with Glen. So if you enjoyed what he said there, you'll enjoy what he said also in the magazine. So a final word from me is to thank StepChange for another successful partnership, and to thank all of the speakers, and if we could give them a round of applause, that would be great.